Kia ora, I'm David Chaston with 90 at 9, brought to you by interest.co.nz. This week, get everything you need to know in 90 seconds at 9 o'clock, with news supply chain pressures are about to hit global trading patterns again. But first, US jobless claims were relatively low last week. In fact, seasonally, new claims fell to levels we last saw in September 2022, and continuing claims were down to October 2023 levels. Those losing jobs in the US are clearly having a relatively easier time in finding new positions. No sign of labour market stress there yet. And US December housing starts have come in better than expected, although not quite as up to the November levels. But they were 7.6% higher than a year ago, and there was a big jump, 6.1%, in residential building consents being issued. So the future looks okay for the sector. But the latest Philly Fed factory survey was downbeat, a bit like from some other regions. New order levels are shrinking, but perhaps at a slower pace than previously, but shrinking all the same. This report covers an important and very large heartland manufacturing region. Australia shed 65,000 jobs in December from November, with a huge 107,000 retreat in full-time jobs, and only 41,000 extra part-time jobs replacing them. Their December jobless rate stayed at 3.9%. And Australian inflation expectations have settled in at 4.5%, the same in December as November. It has been sticky between 4.5% and 5% since March 2023, at a level that the RBA is unlikely to feel comfortable with, given their target is between 2% and 3%. And there is no evidence they're moving towards that. And the IEA has updated its forecast for oil demand, and the IEA has updated its forecast for global oil demand, and they are higher for 2024, both from the Suez supply chain disruptions and from rising demand from China. Global inventories are lowish at present, especially in the US. This report, and a similar one from OPEC, raised oil prices today. And the spreading of Middle East tensions and fights has resulted in another very sharp rise in ocean container freight rates. They were up a stunning 23% last week and now increased 82% when compared with the same week last year. That is now even affecting outbound Trans-Pacific routes, where they rose 38% last week. Capacity demand for avoiding the Suez Canal and Red Sea have jerked things around a lot. China's factories won't be enjoying the cost consequences. Meanwhile, though, bulk cargo rates continue to ease. The US Treasury 10-year yield starts today at 4.14% and up another 2 basis points from yesterday. And the price of gold will start today up $9 at just on $2,014 an ounce. And oil prices are a lot firmer, up $2.50 at just under $74 a barrel in the US, while the international Brent price is now just over $78.50 a barrel and up $2. And the Kiwi dollar starts today at 61.1 US cents, a little change from yesterday. Against the Aussie, though, we're down a quarter cent at 93 Australian cents. Against the euro, we're unchanged at 56.2 euro cents. That all means our trade weight index starts today at just on 70.1 and virtually unchanged. Get more news affecting the economy in New Zealand from interest.co.nz. Kia ora, I'm David Chaston, and we'll do this again on Monday.